I've learned not to hope for things in the stock market.
The only way to move towards being right more frequently is to acknowledge when you're wrong and adjust.
I can only put so much energy toward trading because I've got other things on my plate.
You are listening to Right of the Chart, the podcast for self-guided, independent traders.
Hey everybody, thanks for joining the podcast today. I am Sean Vincent. I am the voice of Right of the Chart. Adam Sarhan, he's the brains behind Right of the Chart. Adam's not joining us today in person, but he will be here in spirit. We're talking instead to friend of the show, Mark Fishman. Mark has been on the show before. He is a student of Adam Sarhan and his A.M.P.D trading strategy. Mark and I are going to talk a little bit today about how we've used that strategy to manage our risk during the volatility that we've seen over this summer. One thing that we talk about is how you have to recognize and embrace your mistakes. You have to be a self-correcting mechanism to learn and become better at trading in the market. We're also going to talk about the difference between having a dollar cost average buy and hold portfolio and maintaining an active trading portfolio.
But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice. You know, there's a certain point when you're a student of something that you also become a teacher of the thing, and then you are a practitioner at some point, and then you follow the tactics, and then as you really understand them, and you can only understand things through doing, I believe. Right? So you can read about anything in a book, but until you've actually done it and you realize you discover what all the little hard choices are that are impossible to detail out in some sort of logic structure, and then you have to make that call in real time. That's when you understand it, or at least you start to understand it by doing. And you might make the same mistake 2-3 times before you realize, okay, I believe that now.
I'm always have time adjusting and learning. Trust me, I still feel like a student.
I'm reading Yuval Noah Harari's new book, Nexus. He's the author of Sapiens, and he's an anthropologist, historian, and he talks a lot about, for me, I think a lot of what it means to be a person and living in a civilization is that we we live in a world of information, and our job is to interpret that information, and then we have to make often important decisions based on that information, and we have to decide what we expose ourselves to and what weight and credibility to give it. But now he's getting into how does AI do that, because AI lives in the universe of information as well. And the AI that is successful is the AI that never believes that it knows everything about what it's doing. It has a mechanism for self-correcting. And I think when we talk about the P and A.M.P.D, the psychological analysis, I think a lot of people feel like if they change what they think they know, that's somehow a sign of weakness. That if they admit that they were wrong before, that they were wrong. Whereas the only way to move towards being right more frequently is to acknowledge when you're wrong and adjust and make those changes. We have to be self-correcting mechanisms in order to always be getting better. You know what I'm saying?
Yeah, I totally agree. Yeah, because you think, oh God, I screwed up, or I've been doing it wrong all this time. But it is definitely a lot of self-adjustment for sure. And I'm still, you still learn the game, and you were still human, right? So we get FOMO or whatever. I wrote those books down, so I'm definitely going to take a look at that.
Yeah, you talk about FOMO or so I experienced. I think most AMP traders, if they had their protective stops set, stopped out of most, if not all, of their positions when we had this correction that started back in July. Was that your experience?
Yeah, a lot. Now, what I was going to bring up is I might do a little bit different just because I own a business, right? And I can only put so much energy toward trading because I've
Right.
got other things on my plate. And so there are certain ETFs, let's call them, or a couple equities that I have held for a long time because I'm so up on them. Like we can talk about this, like VU. Like I'm just not going to sell it. It's just, maybe I'll buy it when it's at its low or something. That's one of my things is I kind of have a foundation of a handful of stocks that I just kind of keep because I've had them so long and they've done so well. I would rather just buy on some of, but the other stuff, yes, like I'll get stopped out. We could talk about that.
So let's talk about that because
Yeah,
and we know that Adam has talked to his members on FindLeadingStocks.com a lot about how long he is with NVIDIA,
right.
right? And
Yes, for sure.
so in contrast with NVIDIA, I, in the model portfolio that I manage and share with folks, had some nice success with NVIDIA in a couple of different positions and stop outs over the last year.
For sure.
Adam was in long before that and had so much more profit built into it, so that when it had its volatility this summer and after they reported earnings, and even though the earnings report was good, maybe didn't match people's wild expectations, or their wild expectations were already built into the price and
Right.
normal was just time to give it back, right? But he had enough profit built into it to where he could set his stops low enough to absorb that with the belief that it was going to rebuild, and he wanted to be there for that without having to get through the pain of getting in and out of the position, which, let's face it, costs, my estimation is it cost me 3-4% to get out after a peak, and it cost me 3-4% to get back in
Yeah, for
after I
sure.
recognize the bottom. So
Right.
just right there's up to 8%
It's interesting.
that you're giving up to get in and out. And
Yeah.
if he felt that he could absorb it. And so what I hear you saying is that you've got positions that have been successful that you've had
Similar.
long enough to where you can afford, you still got so much profit locked in with your protective stops, but you can afford to let it breathe if you believe that's just a market undulation without freaking out.
And it's a major company, like a major game changing company, or like VU, which, is the S&P 500. And that's just, I see it as one bucket of mine, not all of my, yeah, yeah, I agree. I was going to bring that up actually with him in NVIDIA because I have that with Microsoft.
Yeah.
So, yeah. So, for instance, I have had Microsoft for years, even before, many years, well before the pandemic. When the pandemic hit, I sold a little bit of it, but then it started to correct and I bought more. So, Microsoft to me is kind of similar to Adam's NVIDIA, but I probably have had it even longer than him. And I have a couple different accounts with NVIDIA. I mean, with Microsoft too, right? So one account I've had Microsoft for many years, and I usually just will buy maybe a dip over time with that, just because it's such a powerful company and so diverse. But I also have sometimes will buy Microsoft in a separate account. And if I feel, let's say we're in early July and I decided to buy, let's make this up, $25,000 of Microsoft, and all of a sudden the market turns like it did. And Adam was telling everyone, okay, let's start playing a little defensive here. Um, if I have Microsoft even in a separate account sometimes and I'm starting to lose money and it's breaking through some of the moving averages, even in just that account, I might say, you know what? It's not worth holding on to because this thing could dip 30%, even though I might have another account that's up 200% over time or more.
Yeah.
So I know it seems kind of odd, but sometimes I'll even break it down into which account I have and how long I've had it. So when the downturn happened in, what was it, starting to go down in, looks like, early-ish July,
Yeah.
um, my what I started to do, just like Adam said, okay, it's time to play defensive, is I certainly took off my leveraged ETFs. I have, like, whether it's triple Q or uh, Apple has one, AAPU, and that's my highest risk. So I started to take that off to start playing defensive and then just kind of see what happened. And then the next level is stocks that maybe were like, oh, I'll just take a wing on an IPO. It's maybe not like a Microsoft and Apple and Nvidia, but maybe it's more of a young stock or something. And so, like Toast, I'm just making that up. And so then I'll start layering that off. And I don't necessarily always get rid of it in one day. I'll kind of do it in chunks because you never know what happens with the market. And then my next layer of stocks that I might start selling is I might start selling even like really, let's say I had NVIDIA, but I bought it at a bad point, and if it's already down 2%, and we can all see that NVIDIA is going to be, this thing's,
Undermined for a while.
it's
Yeah.
just going to it. Let's say it broke the 10-day, the 21, it's heading toward and it's in no man's land between the 21 and the 50.
And
And
the
you just know,
50.
like, well, you
No
can't hope.
support anywhere.
There's no support. So that's another thing we can talk about. You don't hope. I've learned not to hope for things in the stock market. So I don't hope for support that, it'll bounce back to the 21-day. I actually will say, you know what? There's just as good of a chance that it'll go down to the 50. And so, it's okay
Okay.
to sell some,
So
you
let's
know?
let's pause for a second, because
Sure.
you've got a whole bunch of great stuff for us to
Okay.
talk about,
Yeah.
right? And our audience are the self-guided independent traders of all different skill sets and knowledge, and so we're going to go back and look at some things. So one thing I think is important is the A.M.P.D trading strategy is a very specific strategy for deciding when to buy an equity and when to sell an equity. And it manages risk in large part by using protective stops that go in usually between 5 and 7% below your entry point. Often, for me, especially below some visible area of support. A lot of times for me, it's the 21-day moving average. Sometimes it's just the bottom of a base if it's creating a nice little handle off of a breakout or a flag, right? But
Mhm.
anyways, you identify where support is. You're underneath that, no more than really 5-7%. And then we limit our position sizes to 10% of our portfolios or so. The idea is you never risk more than 1% of the portfolio altogether. My risk tolerance is much smaller. I usually have at my maximum 3% of the portfolio at risk over all the positions at the biggest, right? But that is a particular strategy. And when that happens and the stock goes below your protective stop that you've set in advance based on your tolerance, then you go ahead and let it sell. Now, I have, like I believe you just mentioned, you have more than one portfolio. And some of the other portfolios use, so I have a portfolio that is with investment manager, and it's a traditional dollar cost average buy and hold portfolio. And so what I heard you describe earlier is you've got Microsoft in a separate portfolio that is using a more traditional, more fundamental buy and hold mentality. And when you've already got so much profit in Microsoft, when you see it dip, you'll go ahead and buy some more because your belief is it's going to go up again over time. But you recognize that that philosophy is incompatible with another portfolio that you manage that is the sort of amped trading style, more
Right.
of a swing trade kind of feel, where just because Microsoft's good in your buy and hold portfolio because you've had it for years, that doesn't mean that you got in at a great entry point for the current market conditions, right? And so it
Exactly.
makes sense to sell in one, but to hold in the other. It seems counterintuitive, but two different philosophies for profit and for managing risk.
Yeah, that you broke it down perfectly. So, for instance, I we might have discussed this last time we spoke. Is I How long ago was it? In 1996, so a long time ago, right? I bought a mutual fund, T. Rowe Price Mutual Fund, which is like a large cap mutual fund way back then. Okay. And I'm just not going to sell that. So that's like the most extreme example of like a long term, I'm not going to sell it type of strategy. And then I have like Apple and Microsoft and VU in another account, with Schwab, which I really don't touch, and I have great profit. We have great profits with. Okay. But then
Yeah.
I have a more active account that, like we're talking about with Adam, where I definitely, and just so you know, I don't necessarily wait till 6 or 7% all the time. If I see, let's just take a stock. I'm trying to think which. take ARM, for example. Okay.
Yeah.
It's pretty volatile. If it's just not acting right after I buy it, how's this? After I buy a stock, if it's just not acting right and just starts sinking, I don't necessarily wait to 5, 6, 7%. I might sell a little bit of it. Remember, I slowly build up to, and it may be 25% of what I want initially, see how it goes, then another 25%. But then if it just acts pretty sick, or the market turns and I'm already like in one day down 6, 5, 4%, I'll definitely, usually, if I'm like, this doesn't seem right, I might sell some. And then, I, like you, I don't necessarily wait till it's 7%, because it could be, I
Yeah.
also selling before that, like even at
So
3 or 4%, I might, if it's not acting right.
that's a good point of distinction there too. So you you put the protective stop in when you buy the equity to stop out if you're wrong, and if you're very wrong very quickly. But what I hear you saying, and I've identified this as well, is sometimes you'll get a sense right after that it's not doing what we expected it to, and there's
Right.
no reason to wait for it to bust through the 5-7% if we think it's going to go there anyway. And what I've found for my strategy is there's been a couple of times where I just gone ahead and pushed a button on that thing and gotten out of it. Palantir most recently, and then I was wrong, and it goes, and I'm like, oh, and
That's a
that
tough stock,
psychological.
Palantir. That is a
So
tough one.
I don't actually trade it anymore, just because it's acted so counterintuitive to me that I can't. It's just not a winner for me. I think other people are going to have success with it. For me, it's going to have to. I've just been bit too many times. But to get to the point, um, what I've learned to do is just pull the stop up real tight. Instead of pushing a button, I just pull it up real tight, and then if it goes down, I'll say all right. But I know I've given myself the opportunity for it to go up. But what I hear you say too is there's also, and this is kind of like more of a swing trade mindset, where let me go ahead and liquidate half this position and pull the stop up, and we'll see the other half rides. But in the meantime, I'm going to go find somewhere else that is behaving better for this other half of my capital that I had dedicated to that.
Exactly. And you brought up a good point, but an example of what we're discussing is, let's say you have a stock that, is in a classic cup and handle, and it's formed the handle, and it jumps up, and, like, let's just say it's classic, this is acting really healthy, and then you buy it, and then it sinks the next day like 5%, and you look at the chart, or and you're in if you had an automatic stop, maybe you stopped out of some of it, but
Yeah.
you're like, that is not how it's supposed to act. And don't just be stubborn about it. Sometimes you could take some money off the table if it's not acting like you thought it would. And maybe a month from now, it created another base or whatever it is, and you can get back in.
All right, everybody, that's the podcast for today. You might be able to tell by my voice I'm a little under the weather, so we're going to call it a little early. I'm going to go relax and recuperate. We'll be back next week with more of my conversation with Mark Fishman. We had a long conversation about lots of cool things. Until then, as we always say, keep your losses small and let your winners fly.
It is definitely a lot of self-adjustment, for sure.